Hey guys, can you hear me? How is it
Yes, we
going?
can.
Hi guys. All right, guys, it is 6:11 podcast Friday. We have a crap ton, caught myself, to talk about today. Um, Lady, if you'd like to kind of do a rundown, or Ro, if you want to do a rundown of what we're going to be talking about today while I get some stuff pulled up.
Yes, give me 1 second and I will give you a quick little update. So today we're going to be talking about current market conditions and what is to come. Kenna worked really hard at putting together some amazing DD. Also, just so you guys know, we have created a subreddit for the BullHouse where you can find all of the DD that we have kind of put together, and you can also participate in that. So make sure you check that out. You'll find her DD on there that she's going to be going over today. We are also going to be talking about the reverse repo market, consumer price index, the transition to Libor to from Libor to SOFR, and then holochain versus blockchain. And we have quite a number of staff members with us today. We have Kenna, Unknown, Sharkbait, Tears Are Sweet.
They are sweet too.
They are sweet. Salty, and I think we might have a couple more joining us. Probably the Indian dude and maybe Chris G. So, and Salty. I don't know if I said Salty. He's our dad joke
Tears
person.
actually tastes salty. He's got a dad joke, but he's only in his early 20s. Crazy.
Yeah, exactly.
It's my field of expertise.
I'm scared of what your dad jokes are gonna be when you're like 40 or 50, dude. They're already at this level at this young.
Yeah, like you think they're good now. Just wait another 30 or 20 or 30 years and you'll see how good they are then.
Exactly.
Yep, glad to be here.
And I guess I'll just go ahead and take this moment to kind of tell you guys what is on the horizon with the BullHouse. Next week, we'll be having Carol Roth visit us on Tuesday at 2:30 Eastern.
Why don't you give
She
a little
recently,
background of what Carol what she does?
well, she's an entrepreneur for one, but she also makes appearances often on network TVs to talk about just the stock market and finance, the finance world. So in particular, she recently was interviewed about naked shorting. So we're going to have an amazing conversation with her next Tuesday to kind of like ask our questions about everything about naked shorting and what can be done and what there is to ask about that. And these guys have come up with some pretty good questions. So you guys are going to want to tune into that. The following week, we'll be having Dr. Trimbath come visit us on Tuesday once again at 2:30 Eastern. And we're going to be, it'll be a lot of fun to talk with her and kind of pick her brain and just talk about finance, investing and kind of financial literacy. So we have a lot going forward and looking forward to having you guys join us with that.
Oh yeah, it's gonna be a very, very busy rest of the month, and I know we also have a few of us working on some big like continuations of the DD that I've posted. So there's gonna be like parts 2, part 3. This is kind of the big reason we started BullHouse, was to look at the market as a whole, right? Like the entire market. So you have Sharkbait with his chaos theory and him really diving into the different bond aspects, and I can't wait for you guys to hear his explanation on all of that, because I'm still learning it, guys. Like for some reason, he starts talking and it's so fascinating, and then my brain's just like, wait, you missed something. We gotta revisit that area, and then I just get lost. So I really can't wait for you guys to really hear his explanation on it, because he just dives so far deep into it. Along with Ani, him and Chris, when they get going, you guys are gonna see what I'm talking about. You're gonna go, wait. So with that being said, do not hesitate to tell us to slow down, back it up. What did you just say? Because we are very guilty of that, of just kind of rushing through things, because it is a second language for us, and we forget sometimes that people don't speak that language. So please let us know if you do need us to kind of back it up. All right.
Who doesn't want to necessarily raise their hand and ask a question and be actually speaking in speaker status, if you like, right above the Trade Talk stage is a channel called Trade Talk Chat. If you use @staff, and I'll show an example up there, if you use @staff and then ask your question, we will monitor those and make sure that we ask those questions on your behalf. I will also be monitoring any YouTube questions that you guys may have. You can ask there. Just to kind of help you guys for those who just are unable to speak. Otherwise, request to speak if you would like, and raise that. If you are in our Discord right now, all you have to do is raise your little hand and we'll drag you up to be speaker and you can ask your question there. I will try to, they do get going and they do start speaking fast, and they are on a totally different level sometimes. And so I think we're going to try to remind them to kind of, maybe slow down and explain, just so we can make sure every listener is learning. And that's the point of the BullHouse, right? Is to make sure that they are learning and kind of learning how to navigate this whole thing. So thank you so much, you guys. And again, Kenna's DD, everyone's DD. I mean, it's just incredible. So thank you guys for sharing and willing to educate everyone else.
All right, guys. So I'm trying to figure out, is this better for the YouTube? I can still a bit closer if that is necessary. All right. What's that?
Sorry, I was just asking, are you asking in terms of your microphone?
Yeah, someone on YouTube is saying speaker's mic is super low, so I'm just trying to make sure it's coming through okay. If anybody in staff wanted to go ahead and check that for me.
Yeah, I'll go check that.
Thank you. Still a little low. I mean, I can't quite yell. I mean, that's not a thing. Let's see. Do you have YouTube turned up? Is everybody else coming through really clear, guys?
Yeah, I hear fine.
Sounds better. All right, great.
Yep, I just checked it and it's sounding all good on my end.
Cool. All right, thank you guys. All right, so you can hear me great. Cool. So yeah, for those that don't know, me, Kenna, I'm having problems with my vocal cords. So I can't talk too loud, but this is about as loud as I can talk for most times. So I will try to speak up as loud as possible. Cool. So if it does get too soft, let me know. I will try to put in my brain again to speak up a little bit louder. So this is why I talk about an hour or so on one of these. But with that said, I am going to post a link to the DD in YouTube and in the Discord. So that you guys can there's all the links that I'm going to be going through will be through this DD. All right. So I'll give you guys all a little bit of a minute to get that opened up. If you want to follow along, I will also be obviously hosting it if you just want to watch on the screen too. But there's some really cool links on here that if you want to go through and manipulate them and kind of see what I'm talking about, it'll be really fascinating for you guys to kind of understand how these charts work. Yeah. All right. Let me see. Let's get this pulled up. All right. We have all of these tabs. Welcome to my world, guys. All of these tabs. All right, let me adjust. There we go. All right, so here's the DD itself. I am not going to read through all this. I just am not going to do it. But basically the overall terms of it, I wanted to bring to light the historical relevance of trends, patterns. So what's funny is that I brought this up, I don't know, 2 months ago, guys? So I was like, hey, guys, there's an occurrence in the 20s and 30s, every 100 years, that there seems to be an economic crisis. At first, we didn't think there was any relevance to this. Come to find out, there is. It's kind of interesting. So what I found, 1920s, obviously we have the 1920-21 economic recession after World War One. We had the Great Depression. 1820s was the U.S. first Great Depression. 1720s was the South Sea bubble, in UK, an economic crisis in 1619, and then dating all the way back to 33 AD. This is just kind of my fun fact. With Julius Caesar, they actually had a financial crisis as well. So as you can see, every 100 years in the 20s or 30s, and someone on Twitter pointed it out, it's a life cycle, right? It's every generation, every life cycle or whatever, they seem to screw something up because we never learn. It's not like history books are written or anything to where we could learn from this mistake, but well, whatever. So then I wanted to go through what exactly am I looking at? So I'm trying to find the historical trend of the NASDAQ, the Dow, and the S&P 500. Yeah. Because these three are the main ones that make up our economy, that kind of are indicating how our economy is trending, right? And so I tried to make this as simple as possible. So we tracked what I put in what the NASDAQ, what the Dow, and the S&P follow. So I'll start here so that we have bigger pictures. NASDAQ is the market capitalization weighted index of over 2,500 common equities listed on the NASDAQ stock exchange. The type of securities in the index include the American Depository Receipts, common stocks, real estate investment trust, REITs, and tracking stocks. They are not made up of like derivatives, preferred shares, funds, ETFs, or anything like that. So this is really just the main overall generalization of the market, right? So this is why when we see the news that, oh my God, the NASDAQ is crashing, they actually halt the day trade. Like you can't halt that. You can't trade on that day. And so they just kind of halt it, right? Because they have to kind of stabilize it, make sure the market's okay. No one like panics out of it. That's usually never the case though. So then we go to the Dow Jones. What the Dow Jones is the second oldest and best known stock market index. Owned by the Dow Jones and Company, it measures the daily price movement of 30 large American companies on the NASDAQ and the New York Stock Exchange, widely viewed as a proxy for general market conditions and even the U.S. economy itself. Starting in 1896, the DJIA is comprised of blue chip stocks, approximately 2/3 of which were represented by companies producing industrial and consumer goods. The rest are chosen from the major sectors of the economy, including information technology, entertainment, and the financial services. So again, big indicator on how the market's going, right? These are our big boys, you know, your Berkshire Hathaway, your Amazon, these expensive stocks that most of us probably can never afford right now. They're up there, right? And so this is something that we definitely need to be watching, is with the Dow, information technology, entertainment, and financial services. I believe we are actually kind of in all of these right now in a sense. Information technology, we have to really kind of keep that tracking based on, you know, our social medias and whatnot and how they're performing and keeping us all connected. And then you have entertainment, so our AMC whatnots. Financial services, well, that's who we're kind of battling, I guess you could say at this point. We have to keep an eye on them. So, you know, if they go down, the Dow Jones is gonna take a nice little beating. So it's just something, it's a good indicator to watch for that part of the market trend, right? And so then we have the S&P 500. This is very heavily weighted in tech. So Apple, Google, Microsoft, Tesla. It is also others, so we'll read what S&P measures the value of stocks of the 500 largest corporations by market capitalization listed on the New York Stock Exchange, or NASDAQ Composite. The intention of the Standard & Poor's is to have a price that provides a quick look at the stock market and economy. Indeed, the S&P 500 index is the most popular measure used by financial media and professionals, while the mainstream media and the general public might be more familiar with the Dow Jones Industrial Average. And so, and like I said, if you guys click through these links that are in the Reddit post that I've put out for you guys can read through all of these. Like these go on forever. And yes, I've read every single one of these. Okay, so now that we know what the S&P 500, the Dow Jones, and the NASDAQ are, we can kind of dive into these charts, yeah? So I'll go through these real quick. So we have the historical charts of the NASDAQ, the Dow, and the S&P, okay? The NASDAQ, being the youngest, will not show the Great Depression. It will not show it because it didn't exist. There's nothing to even consider, right? So it does have the Depression in the 1970s through the 80s. You can see the Greenspan put it when Greenspan did his Greenspan put that basically said that the financial institutions are not to fail. You can see that right there in 87. And we've just been on this insane little bull run, right? I mean, we've had the dot-com bubble, and we got a little dip there with the dot-com. We did have the Great Recession with 08. You can see that here. And now here's 2020. I mean, 2020 should have been a little bit of a bigger dip than what we had. I believe we've dubbed it a pothole at this point. Salty and I did last night. And First Strike. It was a pothole. Someone want to talk? Salty, is that you?
Yeah, I was just gonna say, yeah, it's basically like a little speed bump, essentially.
Yeah,
completely rolling over it.
Yeah, it should have been a bigger dip than that. And so we also can see the same trends with the Dow Jones. You can, all these little gray areas, these are either crashes or corrections and resets and everything, right? So this is just when the market took a little dip. This is going to be relevant in just a minute. So, and then S&P, again, gray areas, you can see the Great Depression, 1980s, the dot-com bubble, and us right now, along with, the Great Depression back here. So those are the historicals. Yeah. Follow each other. They're indicators. If one goes down, they all go down, pretty much. At least that's what it's supposed to do, right? Give me 1 second. So yeah, if we look at the patterns here, if assuming one goes down, they all go down, you'd think that there shouldn't be a divergence, right? So that brought me to this Dow Jones and NASDAQ since 1971. And this one kind of got me curious. So having a divergence between the Dow Jones and the NASDAQ, if you look through the chart, you can manipulate this all you want. For the most part, any time that the two diverge from each other, there's a dip. There's a crash of some sort. So you can see this little divergence here. NASDAQ's, the orange line is the NASDAQ, the Dow is the blue. NASDAQ gets a little funny, and then it crashes. NASDAQ gets a little funny again, and they go down again. Oh, it's going to run again, and it goes down again. So this is kind of I found this very fascinating, that every time that they diverge from each other, which is the greatest one you can see is during the dot-com bubble. It's nice to hear other talking about this. It's been tracking the behind the scenes of AMC for a while. Something scary. Yeah, 100%, Andrew, 100%. It needs to be brought forward, and this is, AMC and GME are just kind of doing their thing, so we might as well look further into the market, right? Prepare for what's to come, because it's not far behind it. That's exactly why we're doing this. So, the dot-com bubble. We see that the NASDAQ became a wild child, and decided to just go have a little party up here at the top and moon on its own, not taking Dow with it, right? There's reasons for this, but because the NASDAQ is based on how much the retail investor is basically buying into stocks. Yeah, it's very retail based, and whereas the Dow is more of your higher money and everything. So when these diverge from each other, typically from what we see, there is a crash. So here is the dot-com bubble. We have 08 where they try to diverge from each other a little bit, but they never fully correct, right, from .com. And this is the frightening part to me. Seems AMC GME is a hedge for what's to come. It is. That's exactly what I would call it, is a hedge for what's to come. This is what baffled me, honestly, is this right here. They kind of were together in 08. Okay, market's looking okay. They're trading evenly. And about the 2011 mark, like we were barely out of the Great Recession and NASDAQ just started running, right? This isn't a good sign at all. And I dare anybody, after everything I've read about this, to tell me otherwise. So what's interesting with this is that I found this pattern, right? And I had to Google it. I had to Google and see, is there something here, or am I just completely crazy? Am I just looking for something? Well, lo and behold, second link I think I found. MarketWatch posted this in April of this year. The Dow and the NASDAQ are diverging. Why that's honey for stock market bears. Oh boy. Oh boy. So I did quote this area. It's not a good sign that wide divergences between the Dow Jones Industrial Average and the NASDAQ Composite Index have become almost commonplace. Consider the number of trading sessions in which there is at least 1% percentage point spread between the returns of these two indices. We've experienced 2 such days just this week alone. On Tuesday, the NASDAQ rose 1.1%, while the Dow fell 0.2%. In Wednesday's session, the mirror opposite occurred, with the NASDAQ falling 1% and the Dow rising 0.2%. Such broad divergences historically have been quite rare. Since the NASDAQ composite was created in the early 1970s, just 12.8% of the trading days experienced such a wide divergence as investors experienced this week. So far this year, in fact, the proportion of these 1% plus divergences has been 34%, almost 3 times greater. As you can see from the chart below, this year's percentage is the highest on record except for the years associated with the internet bubble. So there's more to this article, but that was the biggest takeaway. Like we are in a time being compared to the .com era, and if anybody remembers that, I mean, I was young. I was 9 or 10, so during the .com era, and I remember times being very tough, right? It wasn't like 08's a beast of its own, but .com came with a lot of panic that I remember. I mean, like I said, I was very young, but it was kind of a change in the country in that sense. So it was just something to definitely keep your eye on, right? Like this was kind of like the biggest confirmation bias I could ask for when it's going, oh, hey, you're not completely crazy. So then we go back to the charts. Start looking at the S&P 500. Yes, there is an infinite depth of things happening behind the scenes. Yes, there is. S&P 500 earnings 900-year historical chart. So this is the earnings per share. EPS, guys, I know what the hell is an EPS. Got you. Earnings per share is calculated as a company's profit divided by the outstanding share of its common stock. The resulting number serves as an indicator of a company's profitability. It is common for a company to report EPS that is adjusted for extraordinary items and potential share dilution. The higher a company's EPS, the more profitable it is considered to be. All right, now let me know what that is. I'd ask you if you guys want to see if you can figure out the pattern with this, but I don't think we have enough time tonight to try to get through that. So we'll just dive in, right? What I found, now this isn't 100% throughout history, not 100% out throughout. There are times of disagreements in this theory, but if you do like a 10 to 15 year span, you can kind of see what I'm talking about. So every time, not every time, the majority of the time when the EPS is below the S&P 500 price point, right? So the earnings is way lower than the price point, or they cross in a sense. When the orange line crosses the blue, there tends to be a crash or a correction. It's very interesting. So here's the Great Depression. We have another one here. This is wartime, so you can't really count wartime too much, but you can kind of still see the trend in a sense, like every time they cross. But it's mostly in the more recent time frames, right? So we have a cross here. The 80s were funny when it comes to this chart. But we can see like the Greenspan put, right? Here's 87. Good old 87. I wish they would mark that. I know there was nothing like major, like economically wrong in 87. And this is why I said you have to kind of do it in like 10 to 15 years because it'll change it a little bit on how it looks. And I've sat here and played with this chart way too much over the last 2 weeks, trying to figure out that perfect little time frame. So here you have the .com bubble. It crosses. They both run up together, but eventually start crashing because you can't sustain it. This isn't sustainable, right? So then it crosses over again. We're doing good. EPS is above it, whatnots. The line crosses again in 0708 time frame. 08. And it dips again. We cross back over. Everything is peachy. We're doing good. And then we have another cross right here. December of 2019. And the S&P 500 is still running up. Same like the .com bubble. I don't understand it at this present moment. Like, I understand the fact that the pandemic, yes, guys, I understand the pandemic really hurt a lot of things, but there should have been a trend line that the S&P still followed the EPS in a sense, right? Like, it should have still followed. It shouldn't still be having this massive bull run while the EPS tanked. So that's something else I'm watching, right? So after I figured out all of this, I had to ask myself, are we looking at 1929? That's almost 900 billion margin debt, and the 500 billion plus daily reverse repos seems pretty scary to me. Yeah. Thank you. That's pretty much, and I'm pretty sure Sharkbait and Ani will be touching on those reverse repos in accordance to this. That's why we're talking about a lot of this today, guys, because it all ties in together, right? So I had to ask myself, are we looking at 1929 all over again? Is it possible? Does history really repeat itself? And thank you to my Investopedia friends. Why the 1929 stock market crash could happen again. Investopedia. Someone's reading my brain because I'm very scared now because this was January 31st of this year. So I'm not going to read this whole thing. I'm not going to read it all. The biggest thing that I got out of this, besides that it's a very big possibility, was down here, and this is in the DD that I posted, but it brought me to this Schiller PE ratio, CAPE and everything. Like, I really hadn't looked into this much until now. And I really had to study this. And so it's a trailing 10-year. And it kind of adjusts for inflation. Can't talk anymore. And so it's a very good indicator. And what they found, and this wasn't around during the Great Depression, it wasn't around during the 80s and everything. Like, this is kind of a newer technology in the grand scheme of things, right? And so they ended up running the data through it, and it would have actually picked up some of the biggest market crashes. So this is the Schiller PE ratio on a chart. Let's see if we can update this. Oh, we went up. 37.61. Yeah, I'm going to be tracking this for a little bit, guys. But anyway, so they put all the historical data through it, and then they did find that once they got the algorithm perfectly done, it would have predicted the Great Depression right here. It would have predicted Black Monday, which was 1987. The .com bubble. 08's right here, and we're sitting here at 37.61 today. This was different than what I reported. So we are sitting, our Schiller PE ratio is sitting between the .com bubble and the Great Depression, right? And again, this is adjusted for inflation. It's adjusted. It's not like it's just kind of coming out of nowhere. Like, it's kind of frightening, actually. So we have that. And then this led me to look into the consumer price index. And I did have someone, I can't remember who it was on Reddit. They did bring up a good point. Now, we did have a new CPI number come out that we are up 5% from last year, which is the consumer report right here. For those that don't know, they predicted it'd be like a 4.7, I think 4.3 or 4.7% increase, and ended up being 5%. And so this is the entire layout, food, how much it went up in the last year, food at home, food away, energy price, energy commodity, gasoline, fuel, all items less food and energy, commodities, used cars and trucks. I mean, just everything, right? And it comes out to this, all items is at a 5.0% increase. And this is a pretty interesting little article, not article, but report that if you want to read it, you can. This just kind of lets you know what's going on in our economy, right? So it's kind of it's a little intense. So an increase of 0.6% in a month was kind of, it's a little high. It's high. I'm not going to say little. It's high. But we have things to consider. We had COVID. We have all this money that's been printed. We have the bonds. We have all this other crazy crap. And if you guys ever need something to watch to tell you how frivolous, let me see where this is. This video, and I'm gonna send this out into both YouTube and Discord. If you have not yet watched this, you need to. At least the first 7 minutes. And this will actually tell you how wasteful our government tends to be. So if you guys ever get to, that's a good video to watch. So anyway, then I'm tracking the inflation rate. I'm trying to find the true inflation rate of everything, and that's becoming a little bit harder because with the CPI and inflation rate, my husband actually found that they do not use the same metrics that they have used every few years. They change what metrics they are using to actually get to the numbers that they want to have, right? So, and I mean, if we want to speculate, you have people on Social Security, you have people on different government benefits and stuff, and if the inflation rate goes up, they have to pay them more. But at the same time, I don't know why they pick and choose things that they want to look at for inflation rate. Like, he actually was finding that, and that's part of his DD that he is working on. So I cannot wait for that to for him to release it. But yeah, so that's inflation rate, that's the CPI, that's kind of the big things in this. And what I was saying was, someone on Reddit pointed out that as long as we don't see a steep increase, so like this back here right before the Great Depression, right? As long as we don't see this steep increase, we're okay on at least the consumer price index. That was kind of a good thing to hear. As long as and something to know to keep a lookout for is the consumer price index. Now, if we start seeing a very steep increase in percentages, something to indicate like, oh crap, this is not going to be good. So I shout out to whoever posted on my Reddit post. Thank you for that. So that's something to ease your guys' mind. Is that all? Oh, so then I have the last thing I want to talk about. Where's my tab? Yeah, that's not the tab. Okay, darn. We have this fun little website. So for those that don't know, MaximumPain.com. This is a easy way to digest calls and put options on various stocks and ETFs and different things like that. We as a team have validated these numbers, the data in this, 1,000,000 times. This is the only one I trust if I want to look at stuff in this way. And so just know that if you use this, I have gone through it a few hundred times over the last couple months since we found it, that the numbers, they do line up. Okay. So the big one, and this goes out for a shout out to First Strike veteran Tyson, whatever you guys know him as. Once I showed him my DD, he directly went to the NASDAQ. He went right to the NASDAQ, looked at this, and said, Kenna, you need to look at the puts. So I pulled this up. This is the main graph that kind of shows, well, it doesn't kind of, it shows the number of put options or call options on a certain strike option. Strike amount, whatever. And so what we see here is that this is for June 18th, as it says right now. And yes, I know it's quadruple witching day, but quadruple witching day, I wouldn't assume people would bet the economy is going down, right? On a quadruple witching day, I would assume that people would be more optimistic of our economy, that it would go up. But I don't know. This is just something that I'm going to keep an eye on for the next week or so. But there's 109,957 put options on 300. Guys, the current price is what, 340 right now? So that's something. And then it just kind of 87,000, 67,000. And so then the picture that I have in the DD is this. So this right here, this is a fun little thing. It's a good mental image. And if you go to the very last bar, this, what is it, 92, if you can get on it perfectly. This 92 strike price. This is not how many options are on the $92 strike price. This is the total amount of put options to this point. And it actually increased since I've done my DD, I believe. I really think so, because I think it was at 36 billion, but it's at 40,522,739,100 options. Guys, you have to multiply this by 100 to get the amount of shares. Okay, that's 4 trillion shares betting against the economy right now. So that's the QQQ. And then if we want to pull up the S&P 500. These are the two that ones, the NASDAQ and the S&P 500 that I'm tracking for this instance. Oh, I didn't go to the right date. So that's the 18th. Again, we see a sea of red for the 18th on the S&P 500. Here is this little fun graph again. We have 93,062,680,100 total put options on the S&P 500. The calls are at 27,589,440,800. Like it's drastically different, and it's just kind of concerning. I hope this is just an anomaly. I hope that these options were stupid cheap and they were just kind of making a stupid bet. I really hope that's the case. Because other than that, I don't see the need for this many put options on our economy. And
they have gone up. Let me comment here. They have gone up since March, February, March time when we were first looking at it. We initially started to look at this long back before May. And so when we looked at it back in March, I believe the highest volume was at the it was around the 390 to 400 one for the SPY. And obviously now you can see that it's much higher and a lot more further out as well. So yeah, just wanted to bring you guys your attention to that piece as well as a whole. And then you obviously have the inverses as well that you look at, and you'll see, depending on which maturity data, which week you're looking for, you'll see massive volume for call options as well. So that's pretty drastic when you go into the inverses, the opposites of the QQQ, which is usually the indicator.
I have the SQQQ up right now, and kind of showing the same thing, that same call option and put option trend, right? So that, and just like what Ani was saying, there's a massive amount of call options on the SQQQ. We're looking at 594,093,800 total call options versus 38,193,150 put options. So that is that's a drastic difference in someone thinking this thing's going to go up. Yeah, other than that, guys, this is pretty much it. For the major DD, I say pretty much it, and it's been almost 45 minutes. So I will take questions right now. If anybody has questions that they want to ask at this very moment, type it in YouTube, type it in Discord, and I will stop sharing my screen now. Let's see. Trade talk.
Any questions, guys? At this moment, ask away. Type it in. Any concerns you saw that was shared? Want to give it a couple minutes.
Yeah,
I do have somebody here that would like to ask a question.
for sure.
Sure, go ahead, bro.
Somebody's raised their hand, so.
Oh, hey, all. Can you hear me?
Yeah, we can hear you.
Hey, thank you all so much for doing this. This is a fantastic opportunity. I hope it does continue in the future. This isn't really a question. It's just an observation. A couple years ago, I read a book that I didn't really take into consideration at the time, but it discusses the cycles like you've been talking about. It's called The Fourth Turning, and it basically talks about generations. I dismissed it at the time because it didn't really have any, it wasn't provable, but I guess it does make sense. So, for what it's worth, it goes into 4 cycles basically in having from like a crisis to each generation having a different perspective from that crisis to where it comes to people that grow up not having lived through something and not having had parents that lived through something. And then you see a repeatable mistake, which seems to be the case that we're in right now.
Yeah, we actually Van, is it Neistat? Neistat? I'm gonna get killed for that one. He has a great video that I've been kind of circulating around about that exact topic, like the fourth turn. I'm gonna post that up on YouTube and in Discord for you guys that haven't seen it.
For you.
Oh, you have it?
Can I grab it?
Thank you,
Yeah.
thank you. So yeah,
You're welcome.
Yes, Jimmy Jesus. Thank you for bringing that up. That is something I'm so stoked about.
Yeah,
Right
it's
on.
called Massey's generational theory is another one I've been looking into, and that's sort of the explanation of how what's happening in our parents' time, or even when we were young, too young to understand, and how those connected pieces. It's crazy. We talked about it yesterday. Shark Bait, myself, Lady, and Tears were talking about it. Another thing, sort of like a butterfly effect situation, sort of like an inception situation, and it's just kind of happening again. We didn't even realize it's happening, but it's happening again in a different sense. It kind of connects to what Kenna's DD sort of walked a little bit through as a repeatable thing that's happening, and how history repeats itself. Kind of goes along also with the whole chaos theory that Dr. Shark Bait came up with in his DD. So there's a lot of things that we call him Dr. Chaos because it
It's
fits
just a
perfectly,
nickname.
but-
It's a nickname.
Yeah.
I appreciate that, guys. Thanks.
He's been with us long enough to gain a nickname.
Yeah. So I would love at this point, Shark, could you want to quickly, very briefly touch on your piece, because at this point that Jimmy Jesus just made actually kind of touches on Kenna's point and how your DD potentially connects here.
In the sense of the butterfly effect kind of thing, right?
Correct.
Yeah. So, I mean, absolutely right. Like we understand now that there is a macro market at play, and there's so many different elements to it. We have heard about the reverse repo markets. We have seen the inflation. We see now what Kenna has observed in her DD, and all of it's intertwined, right? They're not running independently. This also goes to talk about the crypto market as well, which is a massive piece that's often forgotten. But funny enough, if you go through the crypto subreddits, you realize that they're catching on now too. They're realizing that they're somehow involved in this entire scheme as well. Personally, I think that all of it was driven by SLR exemptions, which if you're not familiar, I think it's worth chatting about really quickly here. So let me just get you the exact definition of what SLR exemptions were. So at the beginning of the pandemic, the Federal Reserve introduced the SLR relief for banks last year as it was sought to support the economy and amid the coronavirus pandemic. That under the exemption, it allowed banks to hold extra treasuries and deposits without setting aside capital for potential losses. This is very important. I'm going to read that last part one more time. It allowed the banks to hold extra treasuries and deposits without setting aside capital for potential losses. So, why did the Federal Reserve allow this to happen? What was their overall thinking? And at the time, it probably was presented to them as a way to not go into bankruptcy, right? It was a way for the banks to be able to get, a credit card and like unlimited credit card from the Federal Reserve, and being told like, use it only when you're desperate, use it only to keep yourselves alive. So we don't have to give you a bailout later. Now, naturally, as banks usually do, they got a little bit too greedy with all of this. And they ended up going wild, right? So they took on all these different purchases onto this credit card. They started dumping it into the market, which now starts to tie back into what Kenna was saying with her DD. We saw these massive increases to the S&P 500, to Nasdaq, to Dow Jones, everywhere, right? It's just we're seeing this values being pumped up like crazy. Now, alongside that, we also saw the Bitcoin go up like crazy and all the other cryptocurrencies. And the part that always kind of surprised me is that no one stopped to ask, how is this all increasing, right? Where's all this money coming from? And so we found out quickly that it is because of these SLR exemptions. Now, the other piece of this, right, beyond the actual dollar value, is the fact that they allowed banks to hold extra treasuries. Now, this is the part that's scary. This is where we start talking about these reverse repo rates. Are we okay to start going to the reverse repo market? You guys think that's a good transition here?
Yeah, sure.
Yeah,
that sounds great.
You take it away. I'm gonna rest my voice. So
cool. So yeah, we'll bounce between our group here because I feel like a lot of people in our group here have done research around this as well, and we have seen the numbers increasing like crazy, reaching new all-time highs. So I'm just gonna lay out the groundwork here, and then we'll go from there. But essentially, the reverse repo market, if we start talking about these treasuries, so let's go ahead and take even a further step back, right? So the Federal Reserve, as a part of the government, will sell off their own debt to other countries or companies or whatever, right? Like hedge funds, banks, you name it. So these treasury securities are prime debt that the country gives out and can be then used as collateral by other parties. The good thing about it is that it's considered to be the highest rated collateral you can possibly get. So if you guys recall back to 2008, where we had our CLOs now, we would understand that it was made up of a lot of garbage, right? And they were using this garbage collateral to make trades, and it really made the market susceptible because that collateral ended up failing. People weren't able to pay their mortgages, the entire market fell apart, right? It just wasn't reliable debt. So it makes sense that the government would be the most reliable, right? Like they would always pay their bills. That's not going to fail, right? They can print out more money even if they need it. So there's a very low likelihood that it's going to fall apart. So the government's treasury securities, or the Federal Reserve's treasury securities, is the highest rated debt that you can buy. And so what the banks initially had thought, right, is they're like, cool, we got all this extra money, but it's a kind of a funny thought here is that having extra cash on hand for a bank is considered a liability. Now, how might that be so, right? Like they've got money. How is that a liability? And the answer is actually pretty simple. It's simply to do with inflation. So for all that cash they have on their hands, as long as it's not invested in something, the banks are losing money. And this freaks them out, right? Because then that means they're getting beat down by inflation. So, we don't need to look too far. We already see that the CPI percentage, which is the consumer price index percentage, we can often use that as an indicator for inflation. We see that it's reached an all-time high, even surpassing that what it was in 2008. So in 2008, the CPI percentage was 4.7%, and now we've reached 5% as of this month. well, as of the end of May. So this is a little bit scary, right? And the banks realize this, that they're in big trouble. So they decide that they're going to dump in all this extra cash into the treasuries. But the banks ran their own models alongside this. They figure, okay, I see that the banks, or I see that the Federal Reserve is going to have to print out all this extra money. The economy is struggling because of coronavirus. That they're like, all right, it's very likely that the economy is going to crash at some point, regardless of what we do. So the banks thought that they were going to get clever. They're like, we're going to not only make money on these SLR exemptions that the Federal Reserve gave us, we're also going to make money by shorting these treasury securities. This was a big mistake because they're basically betting against the economy. They're betting that the economy is going to go down and they want to make money from it.
So
Except there's, sorry, go ahead.
pause right there. So think about what he just mentioned and look at the planning of these major financial institutions, what they're doing. And it should just tell you that we have some very dirty players in the game, and they're using the money that the Treasury is giving them, in a sense, letting them borrow, to then short themselves. Like
Yeah,
short
they're
the Treasury
using it
stuff.
against them.
Yes.
Yeah,
Like,
So
this
think
is
about
a crazy concept. Like, talk about don't bite the hand that feeds you. The banks are doing exactly that. They don't care. They're just going straight at the Federal Reserve. And the Federal Reserve is not happy about it, obviously, right? Like, they're pretty upset that they're being taken advantage of. So as a result of all this, we encounter now a pretty funny situation where the Federal Reserve is looking at the banks and being like, you can't have it two ways. You know, you can't take advantage of these SLR exemptions and short us at the same time. That's ridiculous, right?
Which is the perfect sort of way of thinking about it, right? The banks are basically banking on the fact, no pun intended, banks are banking on the fact that they're going to get bailed out as well. So that's another piece we'll talk about a little bit later, but I just want to make sure that you have that sort of topic in your head thinking about it.
very reminiscent of 2008 as well.
A little bit.
Well,
Yeah, the setup.
Greediness and how it's essentially the same setup. It's I don't know, reckless per se, but more of they're just doing things that they know that they can get away with without any serious punishment or repercussions, because they'll end up getting bailed out. And that's what happens, is that our financial system and the banks specifically are too big to fail. And when they do fail, they know they'll get bailed out. And that's probably why they make some of these incredibly risky bets. I mean, if you really think about it, it's kind of you said it perfectly, Chris. Honestly, it's just a crazy concept to think that they're the shorting the treasuries right now, considering the SLR exemptions and everything. It's reckless.
Yeah, they've taken full advantage. I think that's really well said. I totally agree with you on that point. The piece that I did want to add, and so when we're looking at 2008 and we're comparing it to today, I mean, the one thing's apparent: the banks haven't changed. They're still looking to take advantage. They're still looking to profit off of people, and they don't care if it crashes the economy. That much is the same. But the way that this is all set up right now is a little bit different, because in 2008, it came down to a liquidity crisis, right? Like, there was just not enough money to keep things going. This time around, what we're encountering is a collateral crisis. Is that we're actually seeing that there's treasury securities that are being gapped in the market. That means they don't exist. And there's this other concept that we've talked about a couple times here before, but it's worth mentioning again, is this concept of rehypothecation. Is that one single treasury security is being duplicated multiple times. That multiple parties have the rights to one single treasury security. This is a big deal.
Hey,
Just to
Shark,
reiterate on that point. Oh, sorry, continue.
Oh, no, I was going to say, is it not arguable that the 2008 crisis was also precipitated by a collateral crisis that we really haven't, that got buried? And secondarily, I think you were about to say this, but why do you think that the Fed knows what's going on? Have you seen evidence of actions taken or indications that that is the case?
Yes, yeah. So, yeah, I guess you could say to an extent it had to do with collateral, but the collateral was not the reason. It wasn't because there was a lack of collateral, if that makes sense, right? It was because there was an overabundance of it. It was trash, is the reality of it, and that ended up failing.
Just excessive excess, basically. Excessive money,
Yes.
excess of value, excess of goods, everything. You think about everything. It's just excessive excess is what Shark was basically getting at.
Yeah. And then the question, Silent, I thought you were going to say something here as well. Maybe you had a point about this.
I just wanted to reiterate on something that you might want to draw a parallel upon. So if you look at the '08 crisis and why Lehman Brothers went down especially, is that they entered a lot of repo agreements, but marked them as sales in their books instead of repo agreements in order to have more cash in hand, which they would then be able to invest into CDOs and whatnot. And once this entire house of cards came crashing down, they suddenly had no money anymore because they entered a bunch of repo agreements and spent the money that they would have been, in a sense required to hold in the back hand to exit out of those repo agreements again. They simply spend it on garbage investments that lost all of their value. And this is basically, in a nutshell, what brought Lehman Brothers down in '08. And now what we're seeing is that instead of rehypothecations being labeled as sales, they're being used deliberately in a way that Bank A has a treasury, goes to Bank B, rehypothecates the treasury. Bank B goes to Bank C, rehypothecates the treasury. Bank C goes to Bank D, rehypothecates the treasury. It's all over the place with a lot of repo agreements. Those treasuries still show up on the books because, they are in a repo agreement. But the actual treasuries, nobody knows who has them right now, who will be able to deliver them, and especially what happens if one of the members should default. Those treasuries will get auctioned off. And now suddenly you're looking at a network of banks that is in a sense intertwined, where if it breaks at one point, all of the other stuff will fall with it, because suddenly you start to see a lot of repo agreements that were used on the books sort of as the minimum deposit that they would have to have. And now that simply has to be gone out of the books because you're never getting that treasury ever again. And that is the problem of this entire thing.
And that brings us as a really good segue into the reverse repo market. And so you might have seen a couple of us talking about the reverse repo market here a couple times, because we see all-time highs now going through each and every single day. And the reason why it's important is because that the reverse repo market is a way for the Federal Reserve to be able to control how many of these treasury securities are out there in the market. And so they're injecting or getting injected with cash, and they're trying to keep the game going as a means to keep interest rates down. Because the moment that the interest rates go up, it means the economy's in trouble. And the main reason why it would be in trouble is because all these banks, during the SLR exemptions, over-leverage themselves like crazy. And it's not just the banks, it's also hedge funds, it's also a lot of different players. And so with these interest rates requirements, if all of a sudden they double up, for example, we're going right through 2008 all over again. And that's what the banks are betting on. They're betting on these interest rates going up and they themselves failing. They're going to try to make money two ways and then get bailed out.
Yeah, that's like I mentioned earlier, right? It's just that the whole bailout piece is super, super important here, is that it's kind of repeating itself in a sense from '08, from Kenna's DD, from Sharkbait's own Chaos Theory DD as well, is just reckless and dangerous for the larger good of our economy also the world itself, because these guys have their tentacles every single way possible you can think of, everywhere. They have it everywhere. And so the danger aspect of here is, while they are shorting the treasury, while they are borrowing, knowing they don't have cash, they continue to, in a way, I don't know if you'll be touching on this, Shark, but it would be good to touch a little bit about the CDOs as well with this point that you're making.
Yeah, fair enough. So I just wanted to answer, there was a question somebody brought up, is the Fed's awareness of being taken advantage of. So there's two pieces to this. The very first is that, yes, like they were very aware. You have to remember that when the SLR exemptions were allowed, it was with very different intentions, with a certain deadline, which was March 31st. So these SLR exemptions are finished now, but the liquidity that was injected into the market is still there. So that's what the Federal Reserve right now is trying to do. They're trying to take control of this liquidity by hitting the banks hard with the reverse repo market. So that's why we're seeing these all-time highs now, and so much money being flown through there. Is that them trying to fight back against all these financial institutions. And so, sorry, do I have somebody have a comment here?
Oh, I'm sorry, it's me again. Hey, should I leave every time? I'm sorry, I have a bunch of questions and I keep coming back in here.
yeah, shoot us with the other question.
Okay, so in that line, that was my question basically. Does the Fed know? So that's interesting. I guess I wasn't really understanding that was the case. I don't understand how the reverse repo market is initiated. So is that the Fed pushing that, basically saying, hey, you guys have to take this, or that's them requesting that?
No, they're requesting. They need it. So the problem is that because the banks have taken out like these massive short positions, it costs them money every day, right? Like they pay a percentage to have these short positions open. And so the Federal Reserve, you guys are asking, like, did they know that they're being taken advantage of? For every day that the Federal Reserve keeps the game going, they're bleeding the banks out. So that money that they took out during these SLR exemptions, they're getting that money back now by bleeding them, right? So the banks are freaking out. They're like, oh my God, we've opened up all of these short positions. And not only that, these are short positions opened up on rehypothecated treasury securities. Meaning these are short positions that shouldn't even exist, right? They're made up on fake assets, on an IOU, essentially. So the Federal Reserve has gotten smart, and they're like, all right, we're going to play that game, and we're going to start bleeding you guys, and we're going to make sure that the economy doesn't fall apart by injecting more cash than you guys have ever seen, right? Or more securities, or more cash than you guys have ever seen. And now the question becomes, well, where are they getting this cash from? And that's a big question. So the M1 and M2 reports that they would historically provide, which were usually pretty good signals for inflation, and we know how much money they're printing, are discontinued as of April, I believe. So we don't even know. We don't know how much money the Federal Reserve is printing anymore. We're in the dark now. I think for like the first time in history, they haven't printed out this report. And so they're doing whatever they want at this point. And the secondary component is that it's highly suspected that one of the major loaners to the Federal Reserve right now is also BlackRock, who have been tapped in before as quote-unquote the fourth branch of the government to inject liquidity into the country. So this is an interesting thought process now, right? Is there a much bigger role that BlackRock is playing in all this?
But just to add to your point, right? I mean, we're talking about Fed's awareness. Fed is very much aware. Just to reiterate,
very aware.
And sorry, go ahead, Rob.
Sorry, I was just going to say, you guys brought up a really good point, a really key piece to that, and it was rehypothecation. And I don't know if a lot of people are aware of what that is. So if you guys don't mind touching on that a little bit, I think it'd be helpful for the newer or the green people into the market.
Yeah, Silent, I thought you had a really good way to explain this. If you want to go through that one more time.
Unfortunately, that is such a long time ago. I would have to read through it once more so that I don't get the facts wrong.
Okay,
I have the definition pulled up from Investopedia. If you
Yeah, go for it.
All right. So rehypothecation is a practice whereby banks and brokers use for their own purpose assets that have been posted as collateral by their clients. Clients who permit rehypothecation of their collateral may be compensated either through a lower cost of borrowing or a rebate on fees. In a typical example of rehypothecation, securities that have been posted with a prime brokerage as collateral by a hedge fund are used by the brokerage to back its own transactions and trades. There's the definition.
Okay. So I think I remember how I explained this. So rehypothecation. You usually, if you are, for instance, an investment bank, have assets that could be shares, that could be loans on mortgages, that could be anything that has any value to it. Now, what you could do is obviously you could simply hold that asset and speculate on its increasing price. Or if you, for whatever reason, see that there is a good opportunity to make a lot of money on the side, but you don't have that cash right now, you could go to someone and say, hey, I got X million in this and this asset, and I would like to have some cash for speculative investment. That I believe gives me a lot of more return than the asset that I'm providing to you, because usually the less risky an investment is, the less returns you get. Case in point with treasuries, they're one of the lowest yielding assets that there is out there. Now, what you can see here in this situation is obviously the person that is set to agree on this agreement is putting themselves in a risky position. Is he going to give that money to that investment firm that basically puts it into a most probably highly speculative investment, or does he keep that money for himself? Now, in order to sort of shift the risk a little bit, what is being done here is assets are being posted as collateral, meaning if the other party that you basically as the money lender gave your money to, if the party defaults on that loan or whatever, you can simply take those assets and then sell them or keep them as you please. This sort of protects you against a loss on your investment if everything should go the wrong way. If it doesn't, well, then obviously both parties profit from it, because the person lending money to you will still want a interest on the money that they've given to you. Does that make sense? Or should I reiterate on that further?
I think that's really well put.
Somebody from YouTube did comment, they're like, rehypothecation example, you exchange a TV for cash at a pawn shop, and then the pawn shop takes that TV to a different pawn shop for cash.
Perfect.
Yeah, I couldn't have put it better.
That's actually a nice way, actually, to be honest.
I guess because there's an added piece to that, right? It's also the fact that they all hold IOUs for ownership over that TV despite selling it. That's the big deal here, is that you potentially have like 10 people, 20 people, which is actually fact. There's some of these assets that are rehypothecated like up to 20 times, that there's 20 different parties that have an IOU for that one TV, basically.
Yes. I was also just going to quickly add, I don't know if you guys would agree with this, but what came to mind when you started talking about the rehypothecation, for me at least, was that scene from The Big Short. I'm sure almost all of us in here, or most of us at least, have seen The Big Short at this point, but the boxing scene where they're talking about, I believe they did mention it, where it's one person betting who's going to be the winner of the boxing match, and then another person betting on the guy who's betting on who's winning, and it's like a chain that can just keep on continuing.
Oh, the poker scene, you mean?
Oh, it was
with Selena Gomez.
Yes, yes.
Yep,
I don't know why boxing, but yes, that's what I was referencing.
Yeah, I think that's a really good way to put it, is that when the bet goes right, and everybody, like let's say the company that they're trying to burn to the ground, or for example the Treasury securities, the Federal Reserve has a really big hardship, then everybody who's in on the rehypothecated assets wins, right? The problem is that when we have the inverse effect, is that a whole bunch of shorts have been opened up, and the economy holds its, I'm not gonna say the word, but it holds it together for an extended period of time. That means that every single party along the way that has gotten these rehypothecated assets and has used them to short is now hemorrhaging money. And now in order to stop hemorrhaging money, they need to find the real asset. But there's a big problem, is that they've shorted more than exists. So it's a position they cannot fill. Now, the funny thing is that this starts to sound really familiar, right? This starts to sound exactly what's happening with all of the meme stocks, right? And that's because it is. It's identical. The setup on the Treasury securities is the same thing that's happening with all of our stocks. And so that's where the problem begins, is that the banks simply cannot find enough of these treasuries to get out of this now.
So, Sharpie, if you will, there is a question from YouTube that somebody had. He asked, so this rehypothecation of assets could go on through many different banks and institutions?
Yes, that's right. So they collaborate. I mean, sometimes they don't even know. They don't even know that they're getting a rehypothecated asset. They think it's the real thing. Same way how we've bought shares, right?
Well, that was crazy. I was just going to mention the exact same thing with shares.
Yeah, so like we don't know. You might have rehypothecated shares for all we know. We all might have rehypothecated shares, which are just IOUs.
So if the treasuries are in such demand, why is the price of them not rising?
So it depends on the supply and demand, right? Like, so the Federal Reserve is not going to destroy them. Obviously they need to keep the economy going, but to a certain extent, right?
Ooh, someone just brought up a good question in the Trade Talk chat asking, what happens if we ask for a stock certificate?
This is a very good question, because this is a question Dr. Burry had. Dr. Burry requested all of his GME shares back in 2020. Guess how long it took them to find all the shares and give it to him? Anyone have any guesses?
They couldn't find it.
3 weeks to locate all of his shares.
Right. And that's a great point that you bring up. And I would say that most of us in here probably hopped in towards the end of January, early February on GameStop, or I mean, maybe some of you have been in it for a little bit longer than that. I can say me personally, that's around the time frame when I got in. But I would say that there's, based off of that and what the short interest was at the time, there's a very high probability that most of us, hell, I mean, this is an assumption, I don't know, but most of us, if not all of us, could be holding IOU shares, essentially.
It's probably a reality. That's actually probably exactly what's happening right now.
I was just going to say that. Let's just call it for what it is. I think it is a reality, because by that time, if you look at those numbers, institutions held over 140% of the outstanding shares. So just think about that. Institutions, not retail. Institutions held 140% of outstanding.
Yep.
Outstanding at one point was 67 million, sorry. So it's a very much a reality that a lot of us potentially are holding synthetics.
And if I'm not mistaken, it even got up to 180% institutional ownership at its highest. And I'll have to check myself to make sure if that's correct, but I can recall seeing that on TD Ameritrade. Now, to just follow up on that stock certificate question you were asking, it's actually a really, I love that question, because it kind of makes me think, like, if just one of us happened to ask for paper certificates or stock certificates to get our shares, it probably wouldn't have a huge effect, right? Because most of us are just individuals with an average amount of shares. But if you applied that concept to a large portion of GameStop holders or, AMC holders too, because we don't know exactly how many naked shorts there are for that stock either, it could be very problematic for hedge funds, or just in general, just locating all of the shares.
I do want to point out this, like there is a little bit of a fault in the plan of having everybody do that. Is that if you're to get physical shares like certificates, that apparently it's much harder to resell those. That you'd have to put them back into your broker in order to be able to sell them later. So there's some issues with that. That's why we haven't done that. Why it hasn't been suggested to people is your shares might be locked up with you personally, and it's like a much more complex process to selling them afterwards.
Definitely. There's no, unless if I'm missing out on something very obvious, there's no place where you can just go and take a paper certificate and exchange it for the market value of that share. But it's still a fun concept to poke around at.
There is an interesting kind of lead here, and somebody on the Super Strong side had asked me to research this for a little bit, and I found it to be quite intriguing because essentially when you look at, there's a company called ComputerShare, which I'm going to share here in the Trade Talk chat real quickly. So ComputerShare is quite interesting because what they do is that they, let me find the official, here it is. So the ComputerShare is quote unquote the official transfer agent and registrar. Now, if that means absolutely nothing to you, don't worry about it. I was reading through this for the first time as well. But essentially what they do is that they directly handle shares from GME. Like you can buy shares from ComputerShare and they will source it from GME directly, meaning that you will have real shares on hand. I had thought about this for a little while. I tried setting up an account, but it seemed a little bit complex. But the one thing I do know about ComputerShare is the fact that it is their actual employees. Like if GameStop's employees, if they get shares from GameStop themselves, they would get it through ComputerShare. So you can, even as like a retail investor, you can actually do the same thing. Kind of interesting concept.
So Sharkbait, there was somebody who had a question from the YouTube channel, and he asked, so where does the can kicking end? Like, will the Fed ever say no more? What comes with that?
Yeah, so there's a couple different theories we have here, and we've talked about a fair bit. I'll use this as a pretty good transitionary period to go talk about the Libor to SOFR transition, which, if any of you recall, I had done a short classroom session a while ago on it as well. But it's worth reiterating because it's starting to become a big playing piece in all this. So the Libor rate currently is easily manipulated. So essentially all of the interest rates that we know of, things like student loans, mortgages, business loans, and even the banks loaning money to each other that would classify as a business loan. These interest rates were built, or how they work is that they are self-reported. So the banks, like Bank A, Bank B, Bank C, they will all report back an interest rate. And the scary part is that the banks have been caught colluding with one another to rig these interest rates. So if anybody's kind of not familiar with how interest rates work in general, the overall concept is that the more bullish that the market is and the more comfortable people are, the more likely you are to lend out money. And the more money you lend out, the more likely you are to drop interest rates as well, so that people can afford to take out more cash. And so this starts to look really familiar, right? This starts to look kind of like our housing market right now, where we see that the interest rates are hitting all-time lows, but the costs of housing are hitting all-time highs, right? And so, like here in Canada, we're reaching average home prices of easily over $1 million, and that's not an exaggeration. That's average right now, $1 million. And so this is becoming quite problematic, kind of scary. and it's taking place in a lot of parts of the world.
Yeah, because we're also seeing it, here in the States too. Because like you have the high inflation with housing costs, like the Michigan. Like this is my favorite one. Is an $800,000 house goes for 1.2 million in Michigan. What the hell's in Michigan to make a house 1.2 million? Right?
Yes, exactly.
Like, I'm sorry, but I mean, like Florida, where I'm at, like our houses, yeah, we're seeing major increases. But it's nothing to that extent that I've seen so far in most areas, like Miami, parts of like Fort Myers, maybe a little bit, but the biggest area that I'm seeing the most inflation is up in the Panhandle, and that's because of Hurricane Michael, going through and wiping out most of that area. So Florida's a little funny in that sense, but California, they're actually seeing some of the housing prices go down because everybody's leaving. Except like I think it was San Francisco. I think I saw somewhere that they're actually experiencing a dip right now in pricing.
Oh wow.
Yeah, weird.
So ultimately, what we are starting to look at is with LIBOR starting to get hit. So this is actually another really big piece of this SLR exemptions and the expectations of the Federal Reserve. So when they first gave these SLR exemptions, they demanded that the banks, they're like, all right, listen, I understand you guys have all these contracts written out in LIBOR, or under LIBOR agreements, and you guys have manipulated this historically, but no more. We want you guys to start transitioning to SOFR. And we're being such good guys here that we're also giving you all an extension. So this LIBOR to SOFR transition was supposed to be done by the end of 2020, aka last year. So the Federal Reserve decided to be kind about it. They're like, all right, we understand, times are getting tough. You guys have until the end or like mid 2023. We're giving an extension on this. And they're saying like, so as a part of that, we would want you guys during these SLR exemptions to write all of your new contracts, all of your new loans under SOFR. Right? Meaning, and the reason why SOFR is such a big deal is that SOFR is actually based over the US daily treasury yields, right? So it's something that the Federal Reserve themselves control versus something that the banks control, right? So it was.
Oh, sorry. Chris actually requested to speak. Another Chris. We have way too many Chris's.
Oh, okay.
Yeah. So Chris, if you want to go ahead and unmute your mic.
Well, yes. Thank you. First of all, thank you for having me. And second of all, sorry to bother.
No, don't apologize.
I was invited by a friend of mine to join this trade because I am like, I'm new to this. I don't know how, all of you are talking about this stuff, and I don't understand anything about what you're saying, but I'm trying to learn. But I talked to my friend. We have a Norwegian Discord account, and we are trying our best to stay together, and just, we're trying to stay together as a community and stay together strong. This is it's kind of hard to explain, but I wanted to make a Discord channel where I could at least very much help the new players of the AMC and GME and all these stocks, because I joined Wall Street Bets, and like I joined, and there was so many just comments saying like, oh my God, AMC is falling, GME is falling, all these stocks are falling, and there's so much panic, there's so much FUD, there's so much literal panic going around. I just wanted to help.
Yes.
Because yes, of course, I would love to make some money, but at the same time, this is just more than money. At this time, this isn't about the money anymore. This is about the movement. This is about changing how the world works. So I wanted to help. So I talked to my friend and I said, I want to make a Discord channel to help out whenever I can. And he said, you should join this channel. And I did.
So, I mean, as a suggestion, honestly, feel free to use this as a hub. Like, the idea here is that obviously we have varying degrees of understanding and difficulty, I guess, to get into it. But Sometimes we'll have a little bit more complex conversations like with what we're having right now, and we'll
Yeah.
try to make it as simplified as possible. But feel free to, if you have other people that are trying to learn, shoot them an invite here as well. Absolutely.
Yeah. I mean, not to be rude, not at all. I like this is great. I love this channel already, but I'm sorry to say, but I can't understand shit of what you're saying. I am a total idiot when it comes to this. And
No,
most of the new apes that are joining this community, they have no idea what's going on. They need the very basics. You need to say 1 + 1 is 2.
Oh yes, we do hold those classes. So we have my husband hosting actual economic classes. Like he found a textbook that he goes through, breaks it down. Once he finishes that, he'll be going through micro and macro. First Strike goes through technical analysis. He teaches candlesticks, what a stock is, how it trades, reading charts and all kinds of stuff like that. And we do like we have classrooms where we really do break all of the information down. Just kind of on a 1-by-1 more intimate setting with the Discord community as its own. Our podcast, we really try to get as much information as we can out because we do it 3 times a week. So this is kind of like the speed run, and then we break it all down more throughout the week within the community.
Yeah. I really, really appreciate it. This is amazing. I can't even comprehend how amazing this community is. But as again, I'm not trying to attack you in any way possible.
Yes, Chris, you have to keep listening, keep learning, right? So that's what we're trying to explain. We're trying to break it down for people, right?
Yeah.
But I will say this much, right? So you mentioned Wall Street bets. I do want to clarify, like one of the major differences here is that Wall Street bets is not looking at the big picture, right? They're looking at a very micro view. And I think this is the biggest differential between what we're doing here and what you see on other subreddits and in some places on Twitter, for example, is that people have an understanding of what the big picture is.
Yeah.
And this is the differentiating aspect, right? So essentially what we're talking about and everything about the Federal Reserve and these treasuries and all that, this is the big picture, right?
Yeah.
So it's to give people more reasons to hold long term.
Yeah. Again, I'm not trying to attack or anything, but literally, I'm an idiot. I am a stupid person that I'm really hard at learning. But this is kind of criticism, and I would like to at least tell you that as very, very new apes, please do make a channel that says this is the basics. This is how it works at the very basic level. Because for me, I have a very high learning disability. I have very high troubles actually learning this. For me personally, I want to help the new apes join the community and understand how this all works. And again, I do not want to attack you. You all are doing an amazing job. I just want to give some criticism and help you try to make this better. And by making it better, all I think I can, if you make it stupid, make it for stupid people. Make a sort of a channel where you say, hey, you stupid, read this. And I would gladly, when I joined this Discord channel, there was so much information. There's so much that I just want to leave. And for people like me that we are being confused, it's very simple to get confused by all these channels, by all this information. If you have a channel that is very simply
Chris,
this is how this works, this is how that works.
Hey, Chris.
That would help a lot. Yeah, sorry. Yes.
I'm gonna have to cut you off for a little bit because we are on a time restraint today. We have about 30 minutes left of our podcast, so we are streaming live. For those that don't know, so yeah, I'm gonna cut you off. And if you do have anything you want to suggest to us, definitely talk to us after the podcast. Is that cool?
Yes, I will. Thank you.
Cool. Thank you.
Also, I was just going to speak on that very briefly. I'm going to be posting a poll in the poll chat later with a couple of questions on things, and this is for everyone here in the Discord server, of things that you would like for us to touch on more, things you feel like you don't understand enough, things you feel like you understand well enough. So look out for that later.
I just want to say there's some new people that are joining us on our YouTube live stream right now. And in regards to what Chris says, we will side table that for now. But our group here does have a varying degree of knowledge, from beginners all the way to the deep dives. So our goal is to educate people based on those varying levels.
Yes, exactly.
And
And
ask
it's
questions, guys. That's how you learn, right? Asking questions, asking questions, asking questions.
That's exactly it. And I feel like you slowly start letting it seep in over time. You hear enough of it, you start recognizing things over and over again. You do a quick Google search and like, okay, so that's what that means. And then you're able to start piecing it together. I think it's worth reminding to everybody that, a lot of the people on the GME and AMC side, I've been researching this for half a year now. There is a little bit of a threshold here. We do have catch-up sessions. That's the reason why the BullHouse exists, is that, we have our market hours every single day from market open to market close. And we talk about a lot of these elements there as well. And we help clarify and we'll go over as many times as required for everybody to understand. So I just want to let everybody know that is what we're here for as well. But with that being said, I wanted us to get a little bit more back on topic in regards to what we were discussing just previously, which was the Libor to SOFR changes. So somebody had asked, they're like, how does this game end? How do we see this all come to a conclusion finally? And this Libor to SOFR transition is one that is going to be to pay attention to, because it's going to change how interest rates work and how interest rates are calculated. And so the overall ideology here is that when these interest rates change, that all of the banks and financial institutions who are over leveraged, who have taken on way too much debt on the books, are going to get hit pretty hard, because SOFR, this new interest rate change, is going to make the interest rates much more fair to the entire market, meaning they're going to be a little bit higher. So that's good news for us, because it means that all of these hedge funds and banks and everybody else who's providing liquidity to the market, they're going to start to fail little by little. And what happens when they fail, or what happens when they run out of liquidity? They start getting margin called. And that's when this game finally ends. So it is, in my opinion, that these meme stocks, GME, AMC, and so on, they become these black holes, essentially, that are eventually going to kill off the citadels of the world. And I think that's the game. I think BlackRock and Vanguard and the Federal Reserve, they want to get rid of these players who are rehypothecating assets with ill intent and want to get rid of them. That's my 2 cents, at least.
No, I just want to second that. So I think that's the whole point of this. What we're doing here as well is to bring up these topics organically, as well as looking at patterns and history with Kenna's DD that she's done, in your DD, which you've done, Chaos, as well. Oh, freaking God, chalk bait on the mic, keep calling Chaos. It's very important for us to understand, right? We're all new to some form of information, and information changes so much, changes hands so much. And so it is our duty and job to bring it to you guys in the forefront. To the point that you've made recently, or just a few minutes ago, about this whole rehypothecation and what the role of the government potentially is, and these governing bodies and these big players. I think at this time, it's very, very important for us to really think about that. There's a change that's happening in the world. There's a change that's happening in the way investors are behaving. There are brand new investors that are coming in. Now, right, at one point, we just had a bear market and a bull market. Since this year, there's an ape market, and that just basically is buy and hold. Buy and hold, that's it. And so there's another piece that I want to make sure we communicate out very openly is, do what's best for you always. Don't worry about anybody else. Don't think about anybody else, but do what's best for you. We will do our best to give you the right advice. When you do your DD, your due diligence, or you do analysis or research, you have to take everything with a grain of salt, but when you're doing it also, what you're reading, you need to understand you have to do more than just look at the face value of it.
Exactly. I mean, Actually, Ani, can we just say how awesome it would be if eventually there's an ape outside of Wall Street instead of just the bear and the
That
bull?
would be great. Yeah, put the raging bull out and then put a.
I actually had a
a
thought about
clown.
getting like a big one of those like inflatable apes or something, and like just someone going and putting it up by Wall Street, just kind of next to him.
I mean,
That would be hilarious.
I would do like a
It's
you know,
wonderful
like when
idea.
an ape is petting like an ape petting the bull or something,
Right,
or like
right.
a ape elbow on top of the bull with the stand saying with a peace sign saying like I did it or something, or we did it, something like that, because that
Or
sort of tells
standing,
you it's
or standing behind the little girl. You know what I mean?
even
Yeah,
perfect.
yeah,
that's
I
perfect.
love it. I love it.
We're protecting the girl, which is basically an important sort of notion, or the imagery of that is right. We are in a sense the little girls in this, underappreciated, undervalued, undermined for the longest time in the world, and now we're finally showing up and showing the world, showing the wealthy, the 1%, the 0.5, the 0.1%. We matter. Our voice, our movement, who we are matter.
Well said.
Actually,
And
did
We
you
are
guys?
strong together. Very simple. We are strong together. It doesn't matter
yes,
how many they are. We are strong
yes.
together. Very simple.
And the last piece that I wanted to say, and this is not financial advice by any capacity. I actually mentioned this a little bit earlier today too. The best investing strategy that someone has told me was to buy and keep holding until your thesis has been disproven. So until somebody has proven your thesis wrong, that it is no longer valid, you stay put. Because if you're going to make decisions emotionally, you're going to make losses happen for yourself.
You know, I actually really like that. And, you know, my thesis keeps getting proven right, and I don't like it anymore. Like, I'm like,
Yeah.
can we just prove my thesis wrong already, and I can be happy then. But, I mean, I'm sure, Sharkbait, you feel this way whenever you're doing your DD. You're like, all right, how do I prove myself wrong? Like, I want to be wrong, because, like, at the end of the day, guys, like, the things that we look at, it's terrifying. Like, it's terrifying to be the first one to find it, and you're like, okay, I have to be wrong, or I'm completely, like, missing something, right? And so whenever you get, you know, we all kind of check each other's work and say, yeah, you're right, or hey, maybe fix this, or no, you missed this one. So everything that we do is pretty much peer reviewed, right? And so we want each other to find something flawed, and we're wrong, because we don't want to be right anymore. Like, it's a very terrible feeling, at least in my opinion. I don't know how you feel, Chris.
Yeah, I mean, it is scary, but I think ultimately, like, exactly that same emotion, right? Where you're like reading through something and you're like, you find that the rabbit hole just keeps going deeper and deeper and deeper, and it's like, you know, you're not just making stuff up. It's not just on like some random website somewhere. It's like from like official SEC filings, and you're just, you know, you have this like sinking feeling in your gut. You're like, I wish I was wrong about this stuff, because it implies that everything that we understand what's going on is to some degree true.
Well, and it actually hit me last night. Like, after I posted my big DD last night, it actually hit me, and I was like, am I wrong? Did I just totally put out something that's completely... I was like, wait, there's links. There's actual, like, paper trail of how I figured everything out, and the data that's there is backed by a lot of oh no. And, like, I actually, like, that's what I went to bed thinking about, and I was like, this is not a good way to go to bed.
Yeah, and the peer review aspect is important too, right? So that's kind of the main idea behind Reddit and everything else, is that you have people who are reading things over, who also have an understanding and will add in their own inputs, right? Like they will tell you whether they think you're right or wrong, and they'll have counter DD for you, and they'll explain it, like why they think you might be incorrect about some elements. So that's the entire premise of this. You know, no one here is perfect. No one here is a genius. No one here knows every single thing about the financial market. We can only try our best to, figure out as much as we can. But ultimately, this is the reason why the apes are strong together, is because they are able to provide these different elements of expertise that they all have individually and combine them together. This is what makes this such a strong movement.
We have people
Exactly.
from so many different backgrounds, right, coming together. And we're doing this all for free when we have people that are in the institutions that are trying to analyze everything. And our analytics are overpowering theirs. So I think it's a very powerful movement.
We're essentially a corporation. Well, not corporation. We're essentially a company. Let's go ahead with that. With like 1 million employees. And employees who are from the financial sector, lawyers, data scientists, researchers, you name it. You know, there's all sorts of people here. And everybody's got a part.
Yeah, that's important. I just want to quickly add the somebody just asked a question. Libor efforts. Scotty, boom, boom. We just spoke about it earlier, but there is a transition happening from Libor to SOFR by end of this month. It actually was extended from March to now, to this month.
It's specifically for the business loans. So the last
Right.
Libor business loans, so business loans that can be written with Libor-based interest rates, that is coming to an end at the end of this month. That will be a pretty big deal. So we're going to see what happens after that. But we understand that it's going to start compounding after that point, that the banks might start freaking out a little bit after that. I mean, they're already freaking out. Let's be serious. But
Yeah, I mean, I was just gonna say they're probably freaking out because they're first of all over leveraged, like we discussed. And just want to bring that point up again. They were over leveraged, and they continue to be over leveraged, and nothing is stopping them at this point to be under or drop at their leverage ratios as well.
I see that question from
King.
Desco as well.
And I was gonna say King joined us too as well.
Yes, and so Desco questions, won't that take a while though to feel the effects of that interest rate change? So funny enough, they're going to fail after, I'm pretty sure, the first stress test. And so this is why you're seeing them scrounge up money from their cryptocurrency coffers and other places, is that they're freaked that these interest rate changes is going to create their bills to be so high that they're going to fail immediately on the first month. It's not going to take long at all.
I just wanted to invite, oh gosh, I'm going to kill your name here. Oaf King. I'm just going to call you King to speak.
No, Oaf King works, yeah. Okay, first off, thanks everyone for hosting this. It's the first podcast that I'm being a part of and really enjoying the conversation here. To Kenna and Shark, what you were just saying a minute ago about apes having their own expertise and then bringing it into the peer evaluation process.
Yeah.
I'm reminded of how, I think it was a week ago, when Melissa Lee, the anchor on CNBC, had that shocked face.
Oh, yeah.
Shortly afterwards, of all things, we had an ape who was familiar with acting do a breakdown, right? And talking about the emotion behind it, right? So, from my own background, I'm not claiming expertise, but I am familiar with statistical thinking, economics, behavioral thinking. So, if you're inviting the pushback, I would like to challenge that DD that Kenna had put up.
Of course. I welcome it. Let's do it.
All right, let's have a conversation around it. So, number one, and this was a question that I posed in the chat earlier, is that, I looked up the Wikipedia article on a list of economic crises. And sure enough, yes, from the 17th, 18th, 19th, 20th century, there was a crisis around the 20, 30 year mark of that century. However, that list is also extensive and covers events in other decades.
Oh yeah. Oh yeah. No, I 100%. That's why, like, even in my DD, I was like, there's a lot more. Those were just pretty major ones that I found within that list too, and it just seemed interesting.
And I just want to be careful because while it is interesting, you don't want to be caught off guard and. We use the term confirmation bias.
Oh yeah, 100%.
Right.
Cherry pick. That's why. Yeah, I covered
I'm
that
calling it. I'm calling it. That's confirmation bias because you're looking at a pattern that verifies. Holy crap! There's something here. But consider, of the centuries, those are what 4-5 5 out of the 20th centuries that we have. And of the one that you listed in 33 AD, that is so far back that statistically speaking, you were going to find another one around that area.
Yeah, no, it was that was a fun anomaly. That's why I said just for fun in my DD. I was like, this is just a fun one. Because it started in 40 BCE. It was about Italian land. They were supposed to be buying it and all this other stuff. And the law that went with that just fell by the wayside. And Julius Caesar was the one that found it and was like, hey guys, like this is a thing. And that's what actually caused the downfall of that crisis.
Yeah. I would chalk it up to just the cycle of human nature with like greed and fear over time. But second point that I want to bring up is, so my understanding, because I used to be an index investor before I went all in with meme stocks, the NASDAQ is heavily weighted in terms of information technology, whereas the Dow has a different weighting system as well as a makeup in terms of sectors represented. So for example, they do have a lot more in terms of financial services. So my concern is when you were listing the discrepancies, well, sure enough, you're going to be pointing at the big discrepancy around the .com burst because NASDAQ is infotech weighted, right? And in recent years, over the last 1 or 2 decades, tech has been growing. That is the sector where there's most growth because of the capacities around internet, around cloud, right? So I would say, okay, in terms of the discrepancies there, it's by nature of where we're at in terms of broad human development.
Yeah, and that's also a concern I have too, because the cost of tech and the innovation, they really don't pair up anymore. Like how much we pay for it and the new technology that comes out, it's not worth it. I mean, you see the price of an iPhone. The iPhone keeps going up, and the new technology they put into it. Well, okay, you get a better camera by an inkling in the terms of innovation. So that's actually something I'm looking into as a tech bubble that we might be in.
Oh yeah, on a side note, I'm with you on that. I think we're entering a tech bubble in terms of like FANG. I think where we see next might be biotech. Don't quote me, I'm not an expert on that front. But I think tech is just, it's the recent thing on everyone's mind, right? So that's what people go to. And then thank you for indulging me, but I've got one more point.
No, you're fine.
If I just may here, before we continue on.
Please.
In regards to the Nasdaq and the Dow Jones diverging, while it is true what you just said in terms of especially the weighting of the different companies that are included in it, you also have to keep in mind that while the Dow mostly contains, I would say industries that have proven their right for existence in the market, if you look at the Nasdaq, you're still looking at a lot of companies that in my book are relatively speculative in nature.
Mm-hmm.
Like for instance, not to offend anybody here, but Tesla still has to go through one major crisis before it can prove whether it can sustain its worth or not. And what Elon Musk has been doing in the past is not necessarily advocating for Tesla sticking around, if it should, come to the worst of all scenarios.
Mm-hmm.
Then obviously you're also looking again very much tech focused companies that in and of itself are more likely to become overvalued nowadays. I mean, who does not know a product from Apple? Who doesn't know a product from Microsoft? Who does not know Amazon? If you go through the list, for most of these companies, you actually heard of them. Well, the Dow Jones, or any other index for that matter, there are a lot of companies in there that have their place in the market, but you do not necessarily know them. And especially retail is what drives prices on the market. And if people know a company, they're more likely to buy into it. That is the reasoning approach that I personally would take. So all of these factors sort of combined indicate to me personally, at the very least, that the Nasdaq is more of a speculative investment in general, while the Dow Jones is your safe bet.
Blue chips was the term, right?
Yes.
Yeah, blue chips. So yeah, from what like I said, this is all still a work in progress. Like I've been working on this about 3 weeks. So I wanted to, I'm, getting the basics down, right? Because that's how I try to break all of my DD down is start from the basics. And that's why the true definition from Investopedia, just to kind of see what they track each of them. And then, but it was just as patterns. Like that's, if I don't know if you've seen my mind map, I'm sure you have.
It was given to me. Yeah.
It was given to you. Oh, okay. I get it. So yeah, I do patterns, right? And so far it's worked out in my favor throughout my whole life. So it's just the pattern of seeing divergences, yeah. And from my understanding from other readings is that the NASDAQ is, correct me if I'm wrong, more retail investor driven, because the Dow Jones is the blue chips. Those are the most expensive ones. Those are the what the elite kind of just pile their money into and say set it and forget it, in a sense. So simple terms, right? Am I wrong on that?
I don't have an answer.
Oh.
I know the limits of my knowledge here, so
Right.
I'm not gonna claim either way. But.
Right, and so it was just kind of something to dive into, is just to see the divergence and see. I mean, there's numerous articles about the divergences and who was it? I can't remember. I have to get back to you guys on that. There was someone that I read there was someone on Twitter that posted something about it. I'll have to find it again. But, and this wasn't like, one of the apes. This was, so for you guys that know, like I follow like Ray Dalio and people like that. So I do get good information, right? And so I don't know. There has to be something there. Like there's some people have been saying anything about the bonds being, all wacky, and like them pumping up the economy with all this different money and all this other stuff. And like, they're just basically, in my opinion, guys, solely my opinion, people can shit all over this if you want to. But I feel like they're trying to cushion the three NAS, Dow, and S&P. They're trying to pad it. Yeah, the three indices. God, I cannot talk today. To soften the blow when they tank, right? Like, I don't know. Or some people have been saying like, oh, it's to cover synthetics or shorts or whatever. I don't know about that, but that's just my feeling.
So this actually segues into my final point, and then I'll get out of your way.
Okay.
So in terms of the example that you used where you narrowed the analysis, the S&P 500, I believe it to be, to a 10 to 15 year span, I believe that was the one.
For the EPS?
Yes, that one.
Yeah.
And I just remember as you were explaining it, you were stipulating not always, or, the pattern is tenuous. And this is the statistical nerd in me. You have to be mindful of using 10 to 15 years as a framework when you're talking about the broad market. And one of the terms that is used is regression to the mean, in that over time, you have those bull runs, bear runs. I guess we're entering ape runs, right? But the point is, over time, you're going to have an averaging out. And just to look at a snapshot of 10 to 15 years to pull out a pattern, that can lead to inaccurate conclusions.
Oh, it was more, okay, so for that, like it was more like trying to zoom in on the recession and depression areas to kind of see when and where they started to really cross over. No, I was taking 20, you can ask all of the guys, I was taking 20-year, 50-year broader market, especially when I found that Schiller PE that was a 10-year trailing, kind of like using that as a baseline to kind of see where things start to falter and what causes it, right? And so that's the cause and effect that I was looking at. But no, yes, broad market, 100%, every time.
So
I agree with you on that.
Yeah. But yeah, I think to what was said earlier, and especially with the other guest, Chris, the other Chris, I kept taking the wrong one, but okay. This is why this is so cool, because Everyone has their own strengths and knowledge base, and then it's through conversations like this where we can build on understanding.
Exactly.
So,
Exactly. No,
kudos.
and I appreciate you coming up here. Like,
Cool.
I mean, and that's something that I do want you to know is like, we want challenges because I mean I'm gonna like you've said, like I'm gonna go back and I'm gonna really look at some things, 100%.
Hey, it was only after you said, "Please, I want to be wrong." It's like, all right, if you're inviting dialogue.
No, 100%, and all of us do it. All of us do it. Like, you know, that's where we don't want the echo chamber. Like, what's something that we definitely pride ourselves on is not being an echo chamber and just, you know, rainbows and sunshines. If we can be proven wrong, cool, do it. And I will welcome more insight because like I've been in the market 10 years. Deep dives only started in January, so I'm still very much trying to understand the nitty gritty of it, right? Like I was in medical. That's my background. Like finance was not in my even near my realm of expertise.
Like I said, I was an index investor, so I was all about the passive approach. So, okay, I'll step back. Thank you for your time, Kenna, and
Thanks,
others.
King.
Thank you so much about coming on there, Oph.
Thanks, guys. All right, 4 minutes left.
Oh, well, I was going to say we can extend it a little bit because we didn't get to go we didn't talk about the hollow, if we were going to do that.
We don't have tiers. He just dropped off, so we can cover that at another point. But I just wanted to first take this opportunity to thank our audience here
100%.
On YouTube and here as well. And opening it up for questions before we end it. Any other questions you guys want to quickly type up or ask? Let us know.
Let's see. Digital D on YouTube. So what is everyone's feeling on Dogecoin and the like? Are they being pumped and dumped in the same way to perpetuate, in a way, the deep shortening? Oof.
That's part of the SLR exemptions that we chatted about earlier.
Crypto market right now as a whole, I would say, is heavily affected with everything that's happening in our financial markets. Personally, I believe that crypto is a hedge that financial institutions and hedge funds have been using in the last 1 year, I would say. If you look at the parabolic move of some of the cryptocurrencies, you'll know that that's what's sort of happened. If you can't see that as a pattern, I would encourage you guys to look at Bitcoin, look at Ethereum. Not hating on them on cryptocurrency because I'm a cryptocurrency trader as well, but look at the movement of cryptocurrency as a whole and how that is directly connected to our financial markets today.
It's an excellent point you bring up too, as well as the historical data. That's one awesome thing about being able to trade these things is just looking at a chart and seeing what it's done in the past. And if you haven't already, just like he said, I would look at Bitcoin and some of the other coins and even the mid cap to small cap coins and see what they've done in the past compared to the last year or two. And the unfortunate truth about cryptocurrency is it is literally like the wild, wild west of finance right now. There's no real regulation behind it. There's no reporting. So it's kind of, it's a dark area, right? You can make good money, but it's way less protected than the stock market or other investing areas. But with that being said, I'd just say just look at the historical data and how these coins have reacted in the past compared to the past year or two.
I just want to quickly touch on your point, and it's cryptocurrency, but also in general the market as well, not just cryptocurrency. If you look at how much the S&P has moved in the last 1 year, you'll see that a lot of these hedges have come from that perspective. And I also wanted to quickly read a question that we just got on Trade Talk chat. I've been researching today, just interested in other opinions on best hedges to inflation and possible upcoming bear market, maybe a crash. Oil, bear ETFs, materials.
That is an excellent topic. Sorry, I didn't mean to interrupt. Please continue, Ani.
Go ahead. If you want to answer, go ahead.
No, that I mean, you heard it. I'm excited about that too, because I've been thinking about this a lot personally. And I think that is, my experience is limited in some degree. I haven't been trading as long as some of the other people in here, but I will say that that is something that, at least in my opinion, I think is a great idea to start looking into, is stocks or different securities that you can be investing in that are good in bear markets. And I've already started to poke around at this a little bit, and we don't have anything planned per se, but in the future, I do think that could be something we could look into if you guys were interested in it as well. Is looking into things or investment decisions, I should say, rather, in bear markets or recessions, because I think that could be very applicable to us in the future. And that's just what I wanted to add on there.
For now, we buy and hold, not financial advice.
Right, exactly. But just to wrap up that question, we're still researching. It's still a topic for us to discuss in depth. So thank you for the question. We will be talking about this and researching it. As we get information, we will be sharing it with you guys. Just want to put that out there.
We do have one final question, Sebastian. There was a thesis passed around that 500 was the breaking point for reverse repo. Hypothetically, how high can we go?
The cap is 80 billion per participant. We hit about 11 billion, so it could go a lot higher than what we've seen.
All right, guys. Is that all the questions? Did we get them all?
It looks like we have one more question from Chris, who's wanting to come up. Go ahead and let him back up here to answer a quick question.
His request is gone. Chris, if you'd like to ask a question, if you could just raise your hand again, please.
All right, guys. I think we can go ahead and call it for the day. It is 4:32 now Eastern. If you guys do want to continue the conversation, we will be in our Discord for the next little bit. If you guys want to talk more and ask questions off the live stream, so because I do know some people get a little bit sketched out about hearing their voice or anything on YouTube. So if you guys want to join, the Discord link should be in the YouTube channel if you guys are on YouTube. So if you guys want to join in, it should be there. If not, message us on Twitter or find us, any of us on Twitter. Really, I'm pretty easy. The BullHouse, Lady Love Stonks, Sharkbait, all of us are on there. So just get a hold of us, all right? And I will call it for the day. Bye, guys.
Thanks, everyone.
Thanks.